Hi, everyone. As we still have some folks coming on in, we're going to start in about 2 minutes, so hang tight and we'll get started soon. All right, as it is now noon central, we can go ahead and get started. So welcome everyone. And on behalf of your Baird financial advisor, I'm excited to welcome you to this month's Baird Wealth Strategies webinar. Today, we're joined by Scott Grenier, Manager of Tax and Estate Planning here at Baird, Jonathan Raymon, a Charitable Solutions Strategist with Baird Trust, and Kate Biagi-Rickert, Charitable Solutions Officer at Baird Trust, who are going to cover what you need to know about possible charitable solutions and what strategies can be implemented when giving. But before we get started with the presentation, just a few housekeeping items I'd like to highlight. For optimal viewing, we suggest setting your layout to the side-by-side view via the circle in the upper right corner. All participants are in a listen-only mode, but we would love to hear from you still. So we'll be hosting a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking on the Q&A icon, but please do be sure to address your questions to all panelists. And finally, this presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. We also have the slides linked to the webinar information page, which is linked in that email invitation you received. With that, thank you again for joining us today, and I'll now turn the call over to Kate. The floor is yours.
Thank you, Bailey. So first, I'd like to welcome everybody today. And to keep our legal team happy, I have to start with a disclaimer that Baird Trust does not provide tax or legal advice, and we always encourage you to consult your own advisors in those areas at any time. With that out of the way, I like to turn it over to my favorite topic, philanthropy. Every year, the Giving USA Foundation, in partnership with the Indiana University Lilly Family School of Philanthropy, produces an annual report with details of the previous year's charitable giving totals and statistics and breaks down those details. So in 2023, giving hit an all-time high, passing the $500 billion mark with totals of $557 billion in giving. That's up from 2022's totals of $499 billion, but it is down a little over 2% when it's adjusted for inflation. Where does all that money come from? You can see it's broken down predominantly from individuals, but also foundations, typically family foundations, bequests, and corporations. Ultimately, about 84% of the $557 billion that was given away in 2023 comes from individuals. We usually lump most of those first three categories together, as it's certainly individuals. Foundations are usually family foundations where an individual or a couple gave, and bequests are charitable gifts from somebody's estate, So from somebody that was an individual. So most of the giving is coming from individuals, but corporations are also known to be very charitable. They gave $37 billion last year, and that the percent of giving coming from corporations continues to increase every year. So where did all those dollars go? You can see in the bar chart all the different areas or causes where the giving went. Religion is consistently the top area where giving is directed towards, although every year it's declining just a little bit. You can see where all the different causes fall on that chart, and the combined category of environment and animals is always considered the smallest cause that's supported and is consistently about 3% of those dollars. So we know that people are giving. So 2/3 of the adult population is giving, either by giving of their dollars, their assets, or also by their time. In general, people are more inclined to give charitable dollars the older they get. You can see those details in that giving by generation. It's also, of course, when people have more disposable income. But for millennials who sometimes get a little bit of a bad rap, they're actually outgiving Gen Z. So they are showing that they're very charitably inclined. However, with 3/4 of the older adult population giving, fewer than 6% have a bequest or a planned gift in their estate plan. Many don't realize how easy it is, as well as potentially significant tax benefits that can be available when you give through your estate plan. So I ask you to think about today why you give. It might be a cause that you value. So you might have thought about why you give, or it might just be, oh, I think they're doing great work, I want to give. But you might think about, you might have belief in the cause. And there's certainly so many great causes to support and lots of great organizations. But if you think about it, there might be ones that are obvious to you that you care about supporting with your charitable dollars a little bit more. It also might be a personal experience that you have or loved ones have had, such as a cancer organization or a children's hospital. Or it could be education. You might appreciate the college education that you received, and so you like to give back to your alma mater. Also, people might feel inclined to give because their religion and faith guide them to do that. They're told it's the right thing to do, or there's an expectation to give a certain amount. Other reasons are that you get to see the impact of your dollars at work. Hopefully, when you make a donation, hopefully that nonprofit follows up with you and lets you know the impact through an impact report or invites you to lunch or a tour to learn more about the organization. And so you know and can feel good that you're making an impact with that organization. Also, you can receive a current income tax deduction, and we'll talk a little bit more about that in a moment. While that's certainly usually not the top reason people give, it certainly doesn't hurt. And maybe with what you're saving in taxes, some people say, well, then I have more that I want to give away. Also, you could possibly elect to retain a stream of income from your charitable gift. That's called a split interest gift, such as a charitable trust or a charitable gift annuity. And Jonathan will be speaking on those a little bit more in detail momentarily. But that is where you make a donation, often in your highest earning years, and then you retain a stream of income, which you can defer till a later time when perhaps you're not working and you want that income. Think about the joy of giving. What are some of your early memories of giving? And that can be your time or your treasure. Personally, for me, when I think of my early giving, I think of probably starting at 4 or 5 years old. My parents had us volunteer as a family with the Salvation Army at the holidays and volunteering with the bucket outside of Walmart. And so I remember volunteering my time to do that. And also when I got my allowance, we kind of put it in 3 buckets of to spend, to save, and to donate. And so also donating to the red bucket and to other causes at church or that kind of thing. You can think, what are the charitable causes that are most important to you? Again, some people give just because they're asked, somebody asked them to give or that kind of thing, which is wonderful. But if you haven't thought about it, I encourage everybody to kind of reflect about those most important causes and how you can support them. We say you've got the 4 T's of your time, your talent, that's volunteering as well, and extra areas where you're talented, Also your treasure financially and your ties, your connections, your social networks, encouraging others to join for a church, a nonprofit, or to give, or that kind of thing. You can share the joy of giving with others that you love. Maybe you currently involve your children and grandchildren in your philanthropy, or maybe you don't yet, but there's different opportunities where you could start doing that now. And certainly after your lifetime, you can open a donor advised fund or a private foundation and continue that family giving. You can give the gift of a charitable fund, as if your family has more than what they need, you can start funding some dollars for their charitable giving now. You can pass on those values to them. Also, you can think about, would you like a charitable legacy to be part of your estate plan? We're going to talk about that a little bit more with the leaving your legacy. So as you think about leaving your legacy, there's different ways you can do it in different purposes. One thing that happens when you leave your legacy is that you support and encourage your values for the community. You've put those dollars towards the causes and the organizations that you care most about. Using your estate plan for a charitable gift also allows you to predetermine how your donated assets will be used in the future. You can create a lasting memory of your vision. There's a saying that a person dies twice. First, their physical passing, and the second is the last time that their name is ever spoken. One way to keep your legacy and your name living on forever is doing a charitable gift through your estate plan that is permanently endowed. That is, where it's invested with continual support to the nonprofit annually in perpetuity. And so every time that organization receives that contribution, your name is right there. And it's just like you're continuing to do that annual gift to your alma mater or putting in the collection basket at your religious institution. You can also serve as an example for future generations. You can pass on the values and show that with your family, your values that you might have if you're charitable, of being compassionate, being generous, and having gratitude to organizations that maybe have helped you or made an impact in your life. So what happens if you don't have a charitable giving plan? Well, many people have heard of Prince, or the artist formerly known as Prince. And so he was in the public for a variety of reasons during his lifetime. But after his lifetime, it became public that Prince had no estate plan, nothing written down at all. And, you know, from all his business managers and lawyers that I assumed he worked with, for whatever reason, he didn't have an estate plan. Maybe he thought he was invincible and would live forever. Well, ultimately, his estate was valued, it turns out, at about $163 million. There were different opinions of what that value would be, but the IRS ultimately won out in what they valued his estate to be, which was significantly higher than other assessments. But because of that, the IRS got taxes of about $64 million out of the $163 million. And then Minnesota is going to get their share of $26 million. Ultimately, the state law identified who his heirs were. Prince had 6 half siblings, and you know, he hadn't named them in any kind of estate plan, but they all petitioned to be named as heirs, and so they all ultimately were named earlier this year as heirs, all splitting a portion of his estate. It's been a mess. There's been multiple lawsuits between the different heirs, between the next generation down, his nieces and nephews, and so ultimately none of that went to charity. And that could certainly have been his decision, but Prince was known for being a very charitably inclined person, and he liked to give. And so it can be presumed that if he had made an estate plan, he likely would have named some charitable organizations in his estate plan and also maximized the tax value. When you pass away with your estate, there are kind of 3 buckets where those dollars can go. That can be family, the government, and a nonprofit organization. And so with great planning advisors, you can maximize what goes to your heirs and to charitable organizations and minimize what Uncle Sam gets if that's what your goal is. Prince, it appears, you know, it was an unexpected death, and so everybody might hope to live forever or hope to have a long life, but you never know when that will change. And so there's an opportunity to do planning, even if you hope that you're going to live decades longer, and to consider all different benefits of naming a charitable plan gift in your estate plan. Next, I will turn it over to Scott Grenier, who's going to talk about the charitable income tax deduction basics.
Thanks, Kate. And as you expressed, there's so much to be given during our lifetime, whether it is volunteering and or giving assets to a variety of charities for personal beliefs, religious views, and personal causes that we experience during our lifetimes or the lifetimes of loved one and friends. And you mentioned before, Kate, just maximizing these benefits of giving. And in doing so, we have to contemplate the tax aspect of giving. And so right now, I'm going to walk you through the income tax deduction rules assigned to charitable giving strategies. And we'll take that one step at a time here and take a look at why it matters, right? And when we have clients right now that are giving to charity, we're contemplating what the deduction, income tax deduction might be that they would get on their personal tax return. And the charitable deduction becomes an itemized tax deduction. And in 2024, we have a lot of clients that are looking at the Tax Cuts and Jobs Act that'll be sunsetting at the end of 2025, which means ultimately that some of the income tax, the itemized deductions from our income tax rules are going to change in 2026. Most relevant for a majority of our clients is the SALT, the state and local property tax deduction that is limited to $10,000 a year. That'll become an unlimited deduction coming into 2026. So what we have is a lot of our clients are considering, well, quote unquote, bunching their deductions into 2024 to receive an income tax, an itemized tax deduction in 24, and then taking the standard deduction in 25, knowing that the itemized deduction SALT cap will be repealed come 2026 under the defaults of the sunsetting of the Tax Cuts and Jobs Act. So knowing that our clients are looking at maybe more bunching of their deductions and their charitable contributions in 24, we want to make sure that we take a look at the deductibility of these donations and how they're made. And the deductibility depends on the type of assets you're going to give to the charity and the type of charity that'll be receiving the donation. The most common type of assets that we see being given to charities is cash, appreciated assets, the use of retirement accounts through what I'll call qualified charitable distributions, known as QCDs, and then some advanced strategies where we have charitable trust and the contributions of these assets to maybe not the direct charity itself, but donor advised funds and or private foundations. So let's take a look in more detail then when we talk about giving. And when we talk about giving marketable securities, we're typically looking at assets that have been held long term. And the reason for that is we want to make sure that the long-term asset, which is a security, marketable security that you have held for a year plus 1 day. Anything held for a year or less is considered short-term. Anything for 365 plus a day is considered long-term. And the reason that matters is if you give away short-term holdings, your deduction is limited to your cost basis, which ultimately means if you have an asset where you've given you purchased a stock for $10 per share, and it should otherwise be at $20 per share within that 1 year period, you would not receive a deduction equal to the $20 per share that you give to the charity. Instead, your deduction would be limited to $10 per share, which is your cost basis. By simply waiting for that security to go long-term in nature, which is again, a year and a day. Now the deductibility, once we give that asset to the charity, changes from being our cost basis to the full fair market value, which would take us from the $10 per share deduction into a $20 per share deduction. So always when we're looking at contributing assets of marketable securities, we're typically looking for these long-term held positions. So let's use an example here of using appreciated assets versus maybe giving cash. In this example, you'll see on our left side, we're looking at a married couple giving cash after selling their stock. So in this case, we're going to recognize the capital gains, and then we're going to give the money to charity as cash and take an itemized charitable deduction. So we recognize $8,000 in capital gains, right? So in this example, maybe the client had a $10,000 position with $2,000 of a cost basis held long-term. They recognize capital gains of $8,000. They then give the $10,000 to the charity. They have their mortgage interest. And you can see that next line item is their itemized state and local property taxes, which has been capped at $10,000. And so their total deductions come out to be $39,000 of deductions, $39,650. And the tax due by the client is a total of $40,373. If this case, we had simply just gifted the appreciated assets and not had to recognize the capital gains, we would still be in the same deduction component for the itemized charitable deduction of $10,000, our same other state and local property tax and mortgage interest, but the tax due reduces down to $38,453, which is a $1,900 tax savings to our client. By gifting the appreciated assets that are been held long-term and not having to recognize the capital gain, our client can receive the same itemized charitable deduction benefit and reduce their taxes by giving the marketable securities. Now, when we think about giving the deductibility here, we need to contemplate the types of charities that we're giving the money to. And the way to think about this is, typically speaking, the amount that you contribute to the charity is fully deductible. The question is whether or not you can fully deduct the amount that you give to the charity in the current tax year, or if you'll have to carry over that charitable deduction into the following 5 years. And essentially what the IRS has done here is they've placed a limitation on how much of a charitable deduction you can take in any given year based off of your adjusted gross income. And what you'll see here is, depending again on the type of charity, we've qualified this in the donation to, as well as the cash versus long-term appreciated securities versus closely held stock and tangible personal property. And I'm going to focus on the cash and long-term appreciated securities as those tend to be the most common. However, again, we should note on the far right, there are some other examples out here. But think about a public charity that is receiving cash. If I were to otherwise give $50,000 to a public charity of cash, I'm limited to 60% of my adjusted gross income. So in this hypothetical example, if, for example, my adjusted gross income was $100,000, 60% of my AGI would be $60,000. Because I've contributed $50,000, the full $50,000 would be deductible. However, let's just say my adjusted gross income was only $60,000. Well, 60% of $60,000 is going to be $36,000. And now my adjusted gross income of $60,000 limits how much I can actually give to charity to the $36,000, even though I gave $50,000. That ultimately means that I'm going to carry over $14,000 of my deduction into the following year because I'm limited to 60% of my adjusted gross income. So to determine whether or not we can take a full deduction of the amount contributed to charity, we have to look at the types of charity receiving the assets, the type of asset being provided to the charity and gifted to the charity. And then we also have to look at your adjusted gross income to determine what type of deduction you will be able to take in the current year versus what might get carried forward for future years. When we start giving to charity, we do have to also acknowledge that any gift over $250 that the taxpayer must receive this contemporaneous written acknowledgement before the due date of your tax return or the actual filing date of your return. This is oftentimes done by the charity receiving the charitable gift. However, the charity is not required to provide this acknowledgement unless requested by the taxpayer. That being said, we do see most charities want to acknowledge receipt of the gift and want to thank the donor for their gift being made. But do know that if you're working with a CPA or you're filing your personal tax return, you do need to have this written acknowledgement from the charity in order to substantiate the charitable deduction that you'll be taking. As we start to think about year-end and the timing of gifts, there are a couple of things that I would focus on as we look at the timing of charitable gifts. And that I would start by saying, if you're looking to make charitable gifts in 2024, the remainder of 24, is to start now. Don't wait until December of 2024 to decide to, for example, open up a donor advised fund, the second from the bottom, and wait until the deadline comes up of end of November, beginning of December to try to open a donor advised fund and fund that vehicle prior to the end of the year. If you're using distributions from an IRA, mentioned before, those qualified charitable distributions for individuals that are over 70 and a half, and you're writing a check out of your IRA to your favorite charity, make sure that that check is processed by the charity prior to December 31st of the current year. If you're going to give a check to a charity, make sure that it's mailed USPS by 12/31. Again, USPS by 12/31, not UPS, not FedEx, the United States Postal Service, time-stamped and dated by 12/31 of the current year. And you'll then see that there are some other timelines of charitable gifting strategies, but I would advise you that if you're considering your philanthropic intent is to complete these tasks prior to December to ensure that you do receive the income tax, number one, that your charity receives the gift that you wish to make to them in the current year. And number two, that if you're looking for an income tax deduction, that you ensure that you receive that tax deduction by completing this in a timely manner. Waiting until December means we're in a long line of trying to process other distributions along the way, and the gifts to charities are coming in and people open accounts at that point in time. It becomes a lot for the charitable entities to navigate the receipt of these gifts in these strategies. So with that, I'm going to turn it over to Jonathan Raymon. Jonathan is our Charitable Solutions Strategist within Baird Trust. Jonathan's going to work through the gifting strategies that are available within the charitable philanthropic arena. And with that, Jonathan.
Thank you, Scott. Appreciate everything that you just said there. You know, the government does give us the benefit of various strategies that are able to take advantage of the tax breaks and able to allow you to give tax efficiently. And what that means is it either means more dollars back in your pocket, or ultimately it can mean more money that actually gets in the hands of the charity. So I think this is really important that we look at these various strategies. I would also encourage you to think about, it doesn't have to be one or two of it. These can be used together depending on your goals. And so having some conversations about what do you really want to accomplish and what are the charities you want to support, and we can actually figure out what makes the most sense in that case. And so talking to your Baird advisor is definitely helpful there. I'm trying. There. So the first one I want to talk about is we recognize that the largest asset that most individuals have now are actually our qualified retirement plans. So for those who are turning 70 and a half this year, you are able to take advantage of a qualified charitable distribution at QCD that Scott has already mentioned. Note that this is not the RMD age, so you are able to take advantage of making a qualified charitable distribution from your traditional IRA earlier than when you're actually subject to RMD rules. This is actually the first year that you can, that amount that you can distribute as a qualified charitable distribution is indexed for inflation. So previous to this year, it had always been 100,000. This year is 105,000. What happens is if you are in the requirement distribution age or higher, then this distribution satisfies it. If you're not yet at RMD age, then what you're doing is you're effectively drawing down some of the balance in your IRA that you know in the future will always be subject to ordinary income tax rates at that highest rate that anyone would have to pay. The other benefit here is any distributions that come out of a traditional IRA does go into the calculation for what your Medicare Part B and D premiums are. So in addition to potential tax savings of not recognizing income at those highest ordinary income rates that you're paying, you're also being able to save on those Medicare premiums. It also makes sure that you're not able to have some of those other deductions that might have phase out rules at certain income limitations. I think putting some numbers into practice really helps picture what's going on here. And the way I always like to figure this is a lot of times maximizing your gifts to charity and minimizing your tax obligations is really just a question of which bucket do you want to make gifts out of. So in these two examples, the left hand is maybe the common plan that a lot of individuals do that we see. The right columns are going to be that scenario of simply choosing a different bucket, still having the same outcome, but in being able to enjoy some tax savings there. Again, that will either be in your pocket or you could continue to give that much more to charity. So on the right, or on the left side, we see someone who has a required minimum distribution of $85,000, other income of $35,000, so total income of about $120,000. This person, obviously, if we're in qualified charitable distribution age, we're also getting not only the standard deduction, but that standard over 65 deduction. So standard deduction of over 16,000 still means a tax due of almost 23,000. Now, had that individual simply said to their financial advisor, I'd like to make that qualified charitable distribution of 10,000 that I was going to make anyway, make that as a gift anyway. Would you just issue that check? And I don't have to issue the check. I'll just ask you to do that. Have you send it? Now that individual's only taking 75,000 from the as an RMD and 35,000 in ordinary income. And then the rest of that means that the taxable income is no longer 120,000, but is now 110,000. Still able to claim the same deduction, but what that means is now able to have a tax due of only 20,000. What that means is every single year that this individual does it, that's another $2,600 in their pocket. So significant tax savings in those cases, which again can be used either in your pocket or to give to charity. When we do this, we also talk a lot about thinking about beneficiary designations of IRA accounts. And beyond even 401k and IRA accounts, think about life insurance, annuities. We work with individuals all the time that it's been years since looking at those beneficiary designation forms, and it still lists ex-spouses or deceased family members. So definitely reviewing that beneficiary designation form frequently is beneficial, not only to be able to give that tax efficiently, but just to make sure that those dollars get to where you actually want, even if that's within your family. The other nice thing about beneficiary designation forms is this is a really easy form of estate planning because it doesn't require any legal document. It's simply a form that your advisor can help you fill out. So usually a one-page form that can be changed at any time, but with considerable ease. When we're thinking about these retirement accounts then at death and using that beneficiary designation form, again, we've got the left hand, which is maybe the common plan, and the right hand is the revised plan. Again, simply choosing which bucket to give from. A very typical approach that a lot of people have is to say, well, I'm going to leave a bequest to my favorite charity, whether that's my church, whether that's the Humane Society. I'm going to leave that as a gift that's noted in my will. Now, in that particular case, we're talking about someone who maybe has $1 million of assets. 100,000 of that is outside of their retirement accounts, and 900,000 that is in the retirement account. Now, in this case, the charity still gets 100,000 either the left or right hand side. But the son and daughter, which the idea is that we want to protect for their retirements as well, is that they're getting the half of the retirement account. Unfortunately, every dollar that comes out of a traditional retirement account is going to be subject to the highest tax rates that individual pays. We also know simply from life expectancy tables that often those children that are inheriting those retirement accounts are inheriting that in their prime earning years when they're having the highest tax bracket, and now under secure that has to come out within 10 years. So in this example, even though the son and daughter each get retirement accounts valued at $450,000, they're each going to be paying $135,000 in tax. So how can we change this? How can we make a better outcome for the family and give the same to charity. Well, give from that last will and testament, give that equally to the son and daughter. They get those assets same as cash, because even if it wasn't cash, it does get a step up in basis, i.e. the same amount that is deemed paid for the assets. So there's no capital gain. They get those assets outright. The difference here is the charity now is getting that $100,000 out of the retirement account bucket. Charities do not pay income tax, so we've saved all of that potential tax that would have been owed on that $100,000. In this particular case, simply by choosing these different buckets, and save your children $30,000 in this example. Oh, there was one of the strategies that Scott was mentioning was the idea of bunching, and I wanted to give an example of how that actually looks. And then we can tie that into what sort of vehicles could that be bunched into. So on the left-hand side, we have someone who, the dirty little secret here is that most people don't actually get a tax benefit from giving to charity because the standard deduction currently is very high. So they're giving because they want to give. They're giving because they care about that cause, which is worthwhile and is actually getting those dollars out to what they value. But they're actually not getting any tax benefit from it. So if we were to simply say, instead of giving $10,000 each year, what if I give $30,000 every 3 years? Same dollar amount, but simply bunching it in a given year. And in this particular case, there's no itemized deduction benefit on the left-hand side, but on the right-hand side, able to get a deduction of $11,000 in year one, as opposed to the benefit that you get from standard deduction of $7,300, which means every 3 years would actually have a benefit of about $3,700. The nice thing about this is this can even be combined with the idea that Scott talked about earlier of funding that donor advised fund or private foundation, funding that with appreciated assets. So not only saving by being able to bunch, but also saving by being able to avoid those capital gains. So that's the idea of bunching there. Again, we can do that either with a donor advised fund, or if looking at higher levels amount, we can definitely do so with private foundations. And always like to mention this because there is some difference between the two. Donor advised funds, very easy to set up. Private foundations would be a case where you want a little bit more control. Wouldn't be right in every single situation, but if you're wanting to give the scholarships out directly, you're wanting to be able to give grants internationally, make investments, and have that foundation actually contribute and be actively involved in the community, some other ideas there. The reason why, I mentioned that is while a private foundation can contribute to a donor advised fund, a donor advised fund cannot convert back to a private foundation. So again, just a couple ideas there. Both of them from a structural standpoint are pots of money that are guaranteed for future giving, either by you in the next years or by your children, grandchildren, being able to actually put those dollars back to use in the community and having that positive effect that you were wanting to encourage. One of the other strategies that we've already talked about is, what if you want an income stream out of some of the charitable dollars, and you want to guarantee that at some point in the future, you're going to actually make sure that the charity gets that bequest at your death. A charitable remainder trust is a great option for someone who maybe is looking to exit a family farm, exit a family business, or someone who maybe has a very concentrated position in a company where they're recently retiring. As we no longer work for a particular company, we may not feel comfortable having 50% of our assets in that company stock, and we may want to diversify. But as we've already mentioned, diversifying out of those positions frequently involves generating some capital gains liability. The benefit of a charitable remainder trust is we're able to put those assets in the charitable remainder trust, pay the beneficiaries, often the donor and the donor's spouse, for their lifetime, and then able to get that, again, with that confidence that they have those assets for retirement. The capital gains are not paid upon that initial contribution. In fact, they're able to be sold, and the capital gains are only paid until those distributions come out, maybe over the next 3 decades. So very beneficial there of being able to have that deferral aspect. In addition, it's guaranteed that there's going to be some of those dollars that will go to charity at you and your spouse's death. And so at that point, you are able to get an immediate tax deduction in the year of funding the charitable remainder trust. And as already mentioned, it is able to move out and diversify out of some of those concentrated low basis assets that you might have. There are a few different flavors of charitable remainder trust, and something you can definitely talk to your Baird advisor about. Happy to have those conversations at any time. These are going to be irrevocable options, but it does allow you to have that income stream coming back to you with that confidence of those amounts coming in. There's also another strategy of a charitable lead trust. Current factors are limit the application, but this is something I always like to mention as a potential option in the future, because as already mentioned, at the end of 2025, we're expecting that those estate exemption amounts will drop, and we already know that interest rates are coming down. Those 2 factors mean that charitable lead trusts are going to be effective strategies in the future. Whenever we're considering all of these ones, though, is these tools can be used together. One thing that I see very frequently with clients that I work with is that they want to create a family foundation to be able to engage their children, their grandchildren, and their great-grandchildren in giving and supporting the values that are important to the family. But they still might want that comfort level knowing that they've got an income stream during their life. So perhaps they use a charitable remainder trust to fund their private foundation. Or maybe they have a private foundation and they want a little bit more anonymity, a little bit more privacy. We can always use both a donor advised fund and the private foundation together. So there's a lot of ways that we can work together and figure out what goals are to figure out the optimal way to achieve our goals. Within Baird Trust, there are 3 things that we focus on in the Charitable Solutions Group. We work on private foundation management, charitable remainder trust, charitable lead trust, and nonprofit investment management. If you're interested in any of these ones, talk to your Baird advisor, and we'll be happy to help engage you. And with that, Scott, if you want to wrap it up.
Sounds great. Thanks, Jonathan. And as you can see from today, both with Kate, myself, and Jonathan just now, there's a variety of ways in which we can provide philanthropic interest to various charities that are out there. And there's various different ways to give and potential tax deductions and mechanisms and vehicles that we can use to achieve this philanthropic interest. And as you think about the coordination of the efforts, we want to take a look at the various advisors that you might have as part of your team. We know your Baird advisor is your trusted advisor and the person that you're going to ultimately want to work with to take a look at your initial philanthropic goals that you're trying to achieve both during your lifetime and at your passing. And so again, your Baird financial advisor is going to help you identify not only these intentions, but discuss the potential concepts, techniques, and then bring in your estate planning attorney and tax advisor along the way to confirm the strategies to be executed. Again, your estate planning attorney will typically work with you on the at-death wealth transfer to philanthropic charities at that time, whether that's direct to a charity or some sort of giving strategy that could include a vehicle such as a private foundation or donor advised fund. Okay. Your tax advisor is ultimately going to be taking a look at that potential tax deduction. That tax deduction could be an itemized tax deduction during your lifetime for giving during your lifetime, or an estate tax deduction when we're thinking about potential estate taxes, either at the federal and or state level. Your tax advisor can run multiple year tax projections to look at the concept that both Jonathan and I highlighted before, known as that bunching of deductions, as we're looking at taking deductions in 2024 and potentially using a standard deduction in 25, with the anticipation that the state and local property tax cap will be removed should we sunset from the Tax Cuts and Jobs Act come 2026, and more people are itemizing their tax deductions as the standard deduction goes down and the amount of itemized deductions goes up. So as you think about working with your Baird advisor, it's important that we understand all of your goals that you have during your lifetime, taking a look at all of the assets that you've accumulated during your lifetime to look at the most tax efficient strategy for providing and achieving your philanthropic interest. We know that charitable giving can be extremely rewarding, as Kate talked about earlier today. We know that there's tax efficient ways to give to charities, whether it's again during lifetime or at passing. There's a variety of ways of giving during your lifetime. Most people don't know that although a qualified charitable distribution cannot go to a donor advised fund or private foundation, a qualified charitable distribution can go to a designated fund or a field of interest funds. And there's a lot of different strategies that are out there. Your Baird advisors are here to help you understand these options and bring in the extension of their team, whether it's myself, Kate, Jonathan, or other members within Baird who specialize in philanthropic planning. With that, we're going to see if there are any questions that come in, and want to thank everyone for your time and participation in today's philanthropic giving and providing an update on where we are between now and year end for those that are looking to give more either during their lifetime and or at their passing. And with that, I'll turn it back over to Bailey Mack.
Thanks, Scott. Kate, Scott, and Jonathan, thank you all so much for sharing your expertise here. Well, we're just going to take a moment to remind everyone that if you would like to ask a question, feel free to do so via that Q&A button at the bottom right-hand side of your screen, and just make sure that you address your questions to all panelists. There's not currently any questions in the queue, so we'll just give it a few moments to allow folks to get any questions they might have typed out. All right.
There's a question here of strategies for maintaining perpetual endowment. And that is really a great question. We get that a lot. You can do that either with a donor advised fund or with a private foundation. Again, it depends a little bit on the goals and guardrails you might want to put on that. When you're naming a donor advised fund, you can name perhaps yourself as the initial advisor to the donor advised fund, but you can name successor advisors. So your children, grandchildren, great-grandchildren can be the advisors there. If you don't want that flexibility, you want to guarantee that the charity you've supported annually through gifts throughout your life continues to get that, there's always an option on that contract, that form, to set up the donor advised fund to continually give 5% of the value of the donor advised fund to that particular charity every year. Similar ways can be set up if we're looking at a little bit larger asset value and want to put some family governance language in there. Same types of things can be done with the private foundation. So I would just encourage you to talk with your advisor and start that conversation about what accomplishes the goals you want.
All right, it looks like there's another question that came in on designating a gift to support a scholarship versus funneling the assets maybe through a donor advised fund. And in this example, we can see this go either way, meaning sometimes we'll have clients that'll work potentially directly with an educational institution to predetermine the range of the scholarship and the parameters around the scholarship. Other times we might see clients utilize a donor advised fund for receiving all of their charitable contributions and then segmenting a portion of their assets off specifically for the scholarship. And then other times, as Jonathan and Kate know, we oftentimes see within a private foundation that clients will establish a scholarship within the private foundation where they not only set up the parameters, but can oftentimes then have the board involved in choosing the scholarship recipient, which can't be done when you're part of a donor advised fund. You can establish the rules and the parameters of a scholarship within a donor advised fund. You cannot choose the actual recipient whereas a private foundation offers more flexibility to be able to choose the actual recipient of the scholarship, as long as you're not choosing a family member per se.
It wasn't as much a question, but a really great comment in the chat that 12/1, so the beginning of December, is a key date to be able to make sure that those gifts are being accomplished. So we really encourage you to start thinking about those gifts today and make sure that that's completed by December 1st, so that we know that those are actually being effectuated and actually getting into the hands of the charity and qualifying for that year-end deduction.
Jonathan and Kate, I'll have you address the difference between a donor advised fund and private foundation coming up next, but I did want to address another question that came in here regarding transfer on death and the ability to use beneficiary designations on account types. So at the bank account, it's typically called payable on death, and in the brokerage world, we call it transfer on death. This is used for what we call taxable accounts or non-qualified / retail accounts, oftentimes known as brokerage accounts that are in maybe an individual's name and they want to avoid probate upon their passing, and they'll utilize a transfer on death to transfer the assets, those marketable securities and the cash in that account, to a variety of beneficiaries. And absolutely, you can use that transfer on death component to be able to achieve that philanthropic interest of getting those assets directly to that charitable entity of your choice.
And so there was the question about some of the differences between donor advised funds and private foundations and maybe some of the associated costs with that. You know, one of the questions that I see was talking about the actual legal costs between the two. The difference between a private foundation and a donor advised fund is donor advised fund, you're really taking advantage of someone else's public charity. So it's really just a form. It's a contract that you're filling out with a donor advised fund sponsor, and you're just telling them, that charity, what to do. With a private foundation, you have a little bit more control because you're actually establishing your own 501c3 organization. So with that, you do have to create a legal document to do so. But what you're paying for is essentially being able to draft what those rules, or maybe more control, maybe more involvement, what parameters you want for those gifts to be in the future. So depending on what your attorney charges and how complex you want those rules to be, it is going to vary considerably from one to the other. But again, what you're really paying for in that case is to incorporate and to memorialize those rules that are important to you for something that's going to last in perpetuity. From a pure cost and tax perspective, usually the donor advised fund is going to win out and is going to be the more advantageous option. But we do work with a lot of families that ultimately, either because of the size of the gift or because of the control of making sure that it really does exemplify certain guidelines and guardrails that that family wants to have, and how family members work together, especially if there's multiple branches. The example that I always think of here and I always give is that there's a reason why the Rockefeller Foundation, the Ford Foundation, we all know, we hear those names and we're all very aware of them. It's because they've been able to go on for a century without any changes, because that governing document helps anticipate those.
Great. We had a question on what funds can go into a donor advised fund. And so typically almost any type of gift except a QCD, a qualified charitable distribution from an IRA account, typically anything but that QCD can go into a donor advised fund. So you can do gifts of cash, of appreciated securities, public stock, publicly traded securities, closely held stock, even potentially a gift of real estate or other assets can ultimately, be sold as needed to transfer into a donor advised fund. But the IRS currently does not permit a qualified charitable distribution to go into a donor advised fund.
Yeah, and Kate, we most recently seen people even trying to utilize crypto, which can also be done, having cryptocurrency transferred into a donor advised fund. There are some special entities out there that'll work in this area to help to facilitate the liquidation of the cryptocurrency and then placing those proceeds into the donor advised fund. And I think it's a great call out that you had that a qualified charitable distribution from an IRA cannot go directly to a donor advised fund or private foundation. But again, there are other types of entities out there like that designated fund, what I oftentimes refer to as a sister of a donor advised fund, that can be used as a way of receiving that QCD and is not oftentimes used or known about in the industry. Bailey, it seems that we've answered all the questions that have come in today, so we're going to turn it back over to you to help us close things out.
Sounds like a plan. Thank you so much, Scott. To everyone on the call, we really hope that you found this information both impactful and a good use of your time. And if you think of questions at a later date, if we weren't able to address your question, or if you would like additional information, don't hesitate to reach out to your Baird contact and they'll connect you with the appropriate resource to make sure that your question gets answered. For those of you who'd like to review today's presentation or share it with a friend, family member, or colleague, the session has been recorded and will be made available in approximately 1 week through your Baird Financial Advisor or through bairdwealth.com. And with that, thank you all so much. We really appreciate your time today.